Hey, everybody. Thanks for watching. Thanks for watching this the recording that we've done. Just for record purposes, today is actually the July 2024. We at Good Forsure have thought about how we can maybe just improve our feedback to our clients on a more professional basis. So what we've decided to do is to introduce what we refer to as a quarterly feedback video, where we have Wade, which I'll introduce shortly, from Glacier Invest, just to touch on what has happened in the last quarter. So these videos that will be in the link in the newsletter will also load it on our YouTube channel, which you can actually subscribe to and get notified when we load these videos. It's 15-minute snippets that we give feedback from someone else, like your Raul or Chris or Peter Voges or Leon Simon. You hear it from another advisor at Good Forsure. But we want to give you some feedback from the fund manager or the portfolio manager, Wade Witbooi, which is an integral part of Good Forsure and the way we manage money. So firstly, before Wade's going to give feedback, I'm just going to have Leon just touch on our wrap funds and the wrap funds performance a little bit and what's happened in the last quarter. He'll hand directly over to Wade. Wade will give it back to me, and we'll end off this recording within the next 15 minutes. So I hope this adds value, and thank you for taking the time to watch this. Leon, all over to you.
Thank you, Barry, and welcome everyone. I hope this adds value, give you some peace of mind. As Barry said, I'm just going to quickly touch on our different wrap funds and our portfolios. It's typically for us, we've got these different risk profiles that we look at. For us at Good Forsure, the most important factor is to outperform inflation over the long term. Because that's at the end of the day, if you're not keeping up with inflation, your purchasing power of your money gets depleted. This is especially true of people who are retired, who are in living annuities, etc., and also those still saving towards retirement. So it's always a focus to get long-term growth above inflation with the different risk profiles, but also managing short-term volatility. We're not too concerned about short-term volatility because we understand it's something that needs to happen to get long-term outperformance. And then typically what you see if you compare our portfolios to some other advisors and other businesses out there, you'd find that we are more growth orientated. Now, if I say growth orientated, you're looking at assets that can outperform inflation considerably. So that's typically equity, property, and then offshore assets. And especially in a wrap fund or a preservation type fund where Reg 28 complies, then we're always looking to be close to that maximums for equity exposure, as well as offshore, just because we want to make long-term growth above inflation. And we're glad to say if you're looking at 1, 3, and 5-year numbers, the performance has really been excellent from all our portfolios. Yes, it's been a bumpy ride. If you consider less than 5 years ago, we were still within the COVID setup. There was lockdowns. There was a 35% decline on equity markets in a 6-week period. We've had elections. We've had a lot of factors that's influenced markets, high interest rates, high inflation, low interest rates, low inflation. And yet through all of these cycles, the portfolios have stood up well. And that's not saying it's been smooth riding or that you've had month-to-month positive numbers the whole time. It has been bumpy at times, but it shows when there's a proper process that's followed to select good managers. That's where Glacier Invest plays a massive role for us. Select good managers and also just to stay with those managers in difficult times. We've had lots of examples over the last 5 years where we've had some, I can always say, heated discussions in our investment committee meetings about certain managers and how if we should change them or we should keep them. And looking back, we're quite proud saying that most of the times we've made the correct decision, and the portfolios have reflected that. So yes, with that, I'm going to hand over to
Thanks very much, Leon and Barry, for having me. If you allow, I'll just share my screen shortly so that I can share some of the numbers with you to add a little bit of color and context to what we'll be discussing. So from a markets perspective, we build portfolios with the team at Good Forsure, but also we need to link those to appropriate markets and expected levels of return. So the table you see at the moment is the market indices, both locally and globally, in which we can invest for returns. And I'll pick out a few numbers, which for me at least stand out quite dramatically. So if you look at the year to date, and these numbers are up until the end of June, even though I'm aware we are in July today, on a year to date number, the major indices that we use for return generations are bonds in South Africa. And you can see the all bond index for the year has done positive about 5.5%. So again, not a bad start to the year. And the all share index being equities has done 5.75% for the year. It seems to be a tale of two halves, or the first two quarters, because you can see the 3-month number, which speaks to the second quarter of the year, is actually where all of those returns came from. So the months April, May and June were really kind to investors as SA equities jumped 8%, SA bonds were up 7.5% in the same period as well. And that's as we had a lot of good news and positive developments in South Africa, largely linked to the outcome of the elections, because markets were not actually pricing in, or they weren't preparing what was the eventuality, as we now know, of the government of national unity. And this was broadly positively accepted by markets, by investors, both locally and globally. And our markets have performed in line and actually recovered phenomenally well over the last quarter. If you take the other asset classes we can use, which I'll highlight, is this line over here called the MSCI World NRUSD. And basically, this is the index for global equities for South African portfolios. For the year, it is up quite strongly. So it has been doing well as the US equity market continues to lead the charge from an equity markets perspective. So 11.58 for the year. But you can see in stark contrast to the South African numbers, this was actually down -1% for the quarter. So the local news that was so positive and well received by markets actually caused the rand to strengthen quite materially as well. As we were approaching 20 to the US dollar, when the election results came out and the government was formed, the rand started to make its way back quite quickly towards 18 to the US dollar as the positive news started to be priced in. And while this worked very well for local assets, your global exposed positions in portfolios generally had a downward movement. And this kind of speaks to where markets have been this year. So we had a really good start for global markets for South Africans. And then we had a really good comeback from South African assets in the second quarter of the year. And that's why we continue to believe in the diversification, because it's not just a one-way bet of local or global. So we think the combination of these assets can still suit investors for the long term. It's just about the discipline to stick it out and the willingness to accept these risks in your portfolio going forward. Because if we look at our valuation matrix really briefly, what we see on a global equity front, we use this framework to establish whether we want to be overexposed or perhaps underexposed to certain asset classes. And what it's telling us is that the expectation for global equities is not all falling down by any means. Earnings are expected to grow 3% around about for the next 12 months. And if we compound the next 24 months expected earnings growth globally, it's about 12.5%. And that's a number well in excess of cash and inflation currently. So it still leaves us reasonably optimistic about global equities. So while it isn't cheap and while it has done well, we still think it is still relatively prudent to remain positioned in this asset class. It's a similar story when it comes to perhaps a more risky area of the global equity market. And this metric refers to emerging markets more broadly. In the next 12 months, earnings are expected to grow around about 15.5%. So again, in excess of inflation and cash. And over the next 2 years, a similar compounded number. So global companies and global emerging markets, while being not expensive, seem to have actually the potential for earnings growth as well. And if we expect share prices to do well or markets to do well, it's really positive that the expectation is based upon earnings growth instead of some sort of political or macroeconomic noise. Turning to South Africa, lastly, on the equity front, our market or the earnings are at least expected to grow about 13.5%, slowing slightly over 2-year period to about 9.5%. But since our market has been so discounted over the past few years, there is potentially an expectation that after the formation of the Government of National Unity, potentially having structural reform in South Africa could also continue to be a tailwind and improve operating conditions for South African companies, leading to these base case earnings growth expectations. And if the earnings growth numbers materialize, naturally we expect that to be a positive contributor towards total returns as well. So if I show you our final decision-making slide that we kind of use to guide portfolios when we look at your hard-earned capital, we kind of take the starting position today, as I've shown you what is expected, our starting valuation, and then kind of determine via modeling what a reasonable expected return may be. So returns are incredibly difficult to forecast. So we do have point forecasts, but in our opinion, it's probably more about the direction to tell us whether we should remain invested or consider perhaps turning more defensive. And what this framework leads us to, you can see on the far right, is to remain in kind of invested where we are in portfolios. So the nutshell is the strategies that have worked well for us and brought us these investment successes, we believe should largely be retained in portfolios going forward. SA assets, South African equities and bonds are not expensive by any measure. There are challenges, we do know, but we believe a lot of those are already reflected in the price. So we would not want to be selling these assets after they've already reflected a lot of the bad news over the previous 4 years. We could be at an inflection point. We don't want to miss out, so we are happy to remain invested, potentially overweight, because as Leon mentioned, portfolios do lean into growth at this stage. And we believe, as you can see, both locally and globally, that remaining invested and continuing to have an appetite to lean into risk can continue to benefit your long-term investment outcomes. So that would kind of be a nutshell view of how we view markets at the moment. And while there are many dynamic factors, the largest one being the US election, which continues to evolve week by week as we see, that may continue to drive volatility, but we don't believe volatility is risk. Having a prudent financial plan and the team behind you to do all of the modeling and the financial planning needs, that's more important than who may win an election in another country. So that's the nutshell view on our thinking. Thank you, Leon and Barry. And Barry, I'll hand over to you to wrap up.
Thank you, Wade. Thank you, Leon. Like I said, this is just quick. It's quick. It just adds a view on what our positioning is, what our outlook is, with the assistance of Glacier team that's doing a lot of the research. This is what we see. That's what we've been looking at. So yeah, thank you for watching. And yeah, we hope to see you in the next video. And maybe we can just touch on what we've seen in the last quarter over that. Thank you very much. Have a lovely day.